All right, you guys. Thank you everybody for joining me today on this webinar for the long put spread. We're going to do these webinars a little bit different than what I've done in the past anyway. And what we're going to do here is kind of make a real life scenario where we've come up with a directional assumption in XYZ, let's call it. And what we need to do is figure out what the best option strategy or the best strategy is to implement into our portfolio around that assumption. It's not just as easy as going out there and saying, you know what, I'm going to short this stock, or I'm going to go out there and sell some calls against a bearish assumption, buy puts. It's not always just that easy. Those are all directionally bearish assumptions, but what we want to do is find out what the right environment is, what the right strikes are, what the right duration is, in order to implement the right strategy into our portfolio. Why is that so important? Because it increases our probabilities of success. I can't tell you how many times I've done seminars with other people that are talking about option strategies, and they're kind of cherry picking what they're doing in order to kind of get you guys to jump on board with them. The bottom line is you have to be weary of some of that because they don't always understand all the nuances that are going into these options pricing in order to increase your probabilities of success. On TV, you can watch on CNBC, and if they have a bearish assumption, they'll just say willy-nilly, go out and buy puts, or a bullish assumption, just go buy some calls. That's what I'm doing. Well, at the end of the day, sometimes the environment in and around their strategy is completely wrong. So you could be directionally correct and still lose money. I don't want you guys to fall into that trap. So what I do is I talk about the nuances and why I set up my strategies the way I do. And hopefully that rings a bell with you and you start understanding why these levers and pulleys or the cogs are starting to turn, okay? So without further ado, let me get on with this. The long put spread, we're going to kind of try and take that out of our mind and put that on the back shelf for right now, because ultimately what I want to do is talk about how we come up with our assumption and then how that leads us down the path or down the roadmap to the right option strategy. Okay, so this is the roadmap to trading options. You have one of the best trainings out there, bar none. Thank you very much. I sat through several large training. Thank you, by the way. You are long a call and it goes against you. Can it be repaired? One of the problems with, buying strategies is they're very hard to repair, okay? Now, if you had your assumption change around it, well then, the bottom line is I would say just pull out of it. If you still are bullish in it, one of the things is that you have that defined risk. You can't lose any more than that debit you paid. And that's going to go along with this strategy here, that, you have solace in knowing that you can't lose any more than that. So I usually let the probabilities try and play out if I still have the same directional assumption. I've played around in my time selling calls against, a long call spread, or to make it a long call spread in a sense. But it doesn't end up helping a whole lot because by the time that strategy has started going against you, you're selling a call very close to where you bought that call. And if it flips on you, you could be locking in a loss and stuff like that. So usually on a long call, if you're following my rules, you haven't really risked a ton on that strategy. And I usually let that play out through the probabilities, okay? Does that answer your question there? All right, let me go through a couple of things real quick. My name is Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how that impacts the overall markets. Well, I do the same thing in my daily market commentaries, a little bit in here, but mostly in the daily market commentaries. So you still get all of that color commentary, if you will. But I actually started out trading in college with some money I had earned, and then moved to college, or started trading in college with that money. And I was trying to get a psychology degree, switched it over to finance because I was trading. I was like, this is what I want to do. friend of mine told me to move up to Chicago and go to check out the floor. Well, I did that for a summer job and really grew roots and stayed there for quite some time. So I've been trading my own money, whether it's stocks, financial futures, commodity futures, currencies, and options on all these products and just about all market conditions. So, you know, I've been there, done that. I've learned from some of the greatest people that have ever traded, to be quite honest. And one of the things about being on the floor was that we traded with these trader hacks, if you will. You know, these were the things that we knew when we were getting into the wrong situation, how to try to flip the table or turn the table on that strategy, because sometimes we didn't have the opportunity to cherry pick like we do now with the right environment and stuff like that. So I've gone through the school of hard knocks. So I'm trying to teach you guys how you don't have to do that, as a matter of fact. So you don't have to take every single trade that's out there that's given to you like I had to go through. So I know how those bad trades like buying calls or buying puts in a high implied volatility environment is the wrong time to do something like that, especially for your assumption. Yes, sir. Awesome. Hints training and strategies is awesome. You are buying with implied volatility and volatility crush. Yes, trying to take, ultimately, this comes down to volatility because volatility affects our premiums. And if you take nothing away from this webinar, we know we're buying low implied volatility and selling high implied volatility. And I'm not talking about the VIX, okay? Yes, the VIX does give us an indication as to where volatility is in the entire environment, like it's cloudy across the United States or raining everywhere. That will tell us everybody's being affected by that volatility, right? Well, what we want to do is kind of zero down onto that specific state or that specific town and see if it's actually raining there. Because just because it's high volatility everywhere else doesn't mean that that specific spot that we're looking at on the map has that same environment going on around it, okay? So that's what we're going to talk about with the volatility, is how we kind of, we section that off to see, because every individual underlying has its own implied volatility. Sometimes, you know, like Tesla will never get below a 60 implied volatility. Well, that tells us when Tesla's at 60 implied volatility is pretty darn low. But on the flip side of it, we could be looking at something like Kroger or a utility where they never get above 50 implied volatility. So that would mean that if the volatility for Kroger, maybe, I'm not quoting Kroger right off the top of my head where its volatility is. I don't know where everybody's implied volatility is. I have to look at the charts and figure that out. And I'm going to show you guys how to do that as well. But one last thing, you guys, you can follow me on Twitter at Wolfman's blog. Our parent company is at ProTraderStrat. And if you are on Facebook, check out our ProTraderStrategies.com website on Facebook, because we are throwing out all kinds of content. As a matter of fact, my daily market commentaries are sometimes thrown out there. So if you want to check out that daily commentary where I talk about the economic, geopolitical, and my market analysis, I layer on top of that then my option strategies that I'm putting into my portfolio. I'm not trying to teach you guys to just follow my lead. I might very well be wrong on my directional assumption. I'm not going to lie. I'm not the best at picking directional assumptions. But what I am good at is putting on the right strategy for that assumption, because I know that my probabilities of success are that much higher. All right. So I've been able to do this for well over 25 years and knocking it out of the park this year, despite the fact that, I don't even keep track of whether my directional assumption is right or not. I'm just keeping track of staying mechanical, making sure that I'm following these rules I teach you in these webinars. That will be what makes you guys better traders ultimately. All right, so we did talk about this. It is the long put spread, but we're taking that out, putting it on a shelf somewhere, kind of forgetting about that. That's where we're ultimately going to go to. But let's get a couple of real quick things out of the way. Delta, we need to know what our roadmap key is, and I'm going to go through the Greeks. Yeah, I know that just kind of blew a lot of people's heads off right there. We are going to talk about the Greeks, but I'm going to give you guys little ways to remember these a little bit easier because, yeah, they are foreign words. Why did they pick the Greeks? I don't know. They are even all Greeks. They call them all Greeks, but they're not even all Greeks. So what we'll do is we'll go through these. I'll try and teach you guys little easy ways to remember them going forward. Delta is the effect of an option premium in relation to the underlying. Ultimately, what this is, all of these Greeks are on the assumption they're moving higher, okay? So this is $1 increase in that underlying. Well, our strike is going to be affected by this delta. Delta is also data. It's not just the underlying moves up by $1 and I've got a 50 delta. That means my premiums increased by 50 cents. Well, yes, it does mean that, but it also means delta is the probability of being in the money by 1 penny at expiration. And we have some trader hacks we'll talk about as we go through this on delta and talk about some of the data that it gives us. But for right now, what we really want to come away with on this is delta is the effect on our premium. So I'm just going to check out this one right here. We'll go over to delta, gamma. So we've got our delta, gamma, theta, vega. All right, so great example here. This will make probably a little bit easier for us all catch on to. We've got Yum Brands, just because it's up here right now. We're going to, let me get my pen out here. So Yum Brands, we talked about delta. It in relation to what the underlying does. So for this, we're going to say this increases by $1 just for the assumption. We go plus $1 and now we're at $87, right? The underlying moves up to $87 even. Well, we look down here at the option montage and check out the delta. It's 51 in this particular example. That means this bid and this offer are going to move up by 51 cents if the underlying is now trading at 87 cents. So we could look at this as saying this is now $3.39, all right, on the bid, and then the offer is $3.66. So that would be what would happen to the bid offer. You know, all other things being equal, nothing else is traded. The volatility didn't change. We're just trying to isolate what happens with delta. Vice versa, on the other side, you will notice that delta is a negative number. So if this moved up by $1, that means plus $1 and a negative 49 delta means that our premiums will decrease by that amount. So we're going to basically move these down to $2 and we're dropping by almost 50 cents. So $2.37 on the bid. The offer is going to drop by almost that much. So we're talking $2.56. That's off the top of my head. Hopefully my math is right there. So you can see that those would decrease. Vice versa, if we move down by $1, so forget about this, and we're now at $85 even. $85 even. Sorry, I was looking over here at my crazy 8. $85. So we moved down by $1. Well, think about this. Minus $1 plus a positive delta means it's a negative delta now. So we go down by $1, and these would all decrease by the 51 cents. Vice versa, on the other side, we've got a negative dollar plus a negative delta. Negative plus a negative equals a positive. That would mean that these deltas become a positive delta and then add into the premiums, okay? So pretty quick on that. How to determine the ask price? Could you expand on that? How to determine the ask price on that? I'm just kind of giving a ballpark figure here on this. That's what you're asking about. I'll come back to you when you get on it, because we'll be back on this page in just a minute. All right, so that's delta. Delta is the effect on our premiums for the first dollar move higher, okay? Second dollar move higher, we've got something that's called gamma. And gamma, just think about this, gamma goes with delta. That's all we need to know with gamma. Let me try, my cursor is not wanting to, where's my cursor? There it is. I'm going to change this over to a pen so I don't have to keep changing over. To ink color. I'm going to go ink color black on this and let me make that the highlighter. All right, so basically gamma, I don't know why I went back to yellow, but gamma goes with delta. All right, so gamma goes with delta, but the thing to note here is gamma goes with delta on the second dollar move. So we remember here that this is the first dollar move higher. So this is on dollar number 1, right? This is dollar number 2, okay? So on the second dollar move higher, gamma adds into delta. So if we go back to that previous example, where we've got the option montage, and if you ever hear me talking about the option montage, this is where I'm talking about. So we talked about that first dollar move higher. So we went from 86 to 87, all right? And these premiums increased by this 51 cents. So on that first dollar move higher, we went up to $3.39 on the bid. And then the offer went up to $3.66, right? All right, so that was on that first dollar move higher. Now we have it move up to $88. So this was dollar number 1. Now we have dollar number 2. It's up by $2. Okay. So now after dollar number 1, this is our bid on it. Now dollar number 2, we know gamma goes into delta. So the second dollar move higher, it actually moves up by 56 cents. And, it's going to, second dollar move, this one would move up by 45. It's consistent as we go. But let's stay with this example. So the first dollar move, this is our bid. Now we have another dollar move higher. So gamma goes with delta. It moves up by 56 cents now. So now we're at $3 and we got 56 cents. So $3.95 on the bid. And then the offer, we got 56 cents going into there. We're at $4 and, sorry, I'm having a brain cramp here. $4.22. Okay. Double check that. 6, yes. $4.22. All right. So that's how our premiums are affected. First dollar, we just add delta into it. Second dollar, gamma goes with delta, and we can figure on what that is thereafter. So it consistently will roll up. The next dollar move higher, because you can see gamma is pretty close in line there. We can kind of figure out, all right, the third dollar move higher, now it's going to increase. This was 56 cent increase. This was a 51 cent increase, right? And then the third dollar move higher, we've got gamma going in with it again. So we've got another 5 cents adding into this. And now we're at 61 cents on that third dollar move. This is plus $3, okay? Sorry, are you doing the call side? I thought this was a put spread, excuse my ignorance. Yes, I am. I'm just trying to get you guys to understand how gamma, delta, and all of that affects premiums. Vice versa, which is a great question there. On the next dollar move higher, these are all moving higher. Gamma goes with delta on these as well. But we have to remember that next dollar move higher, the gamma comes out of that delta. So on dollar number 1, for instance, over here on these, we'll look at the puts real quick. So on a plus dollar move higher, let me go back to the white one. So on the first dollar move higher, right, we're going to 87 cents or $87. The second dollar move, we're at 88, right? So now we're looking at gamma going in there. or coming out of it actually. So we've got 49 cents coming out of the bid here. So on that first dollar move higher, we're down to 137 on the bid. And then on the offer, we're going down to 156, or sorry, 256. Is that right? 256.49. Yeah. So that's on the first dollar move. The second dollar, it's only going to decrease by 44 cents because, you know, plus gamma and a negative 49, that negative 49 plus a positive makes it subtract from it, right? So now we're at 44. So the next dollar move higher, these would decrease by 44 cents. I don't have the brain power right now to do it, but on the offer, we could say that these are now at 212 on the bid, and we're talking about this one being about $1.90 something, about $1.90, something like that. Just off the, I'm just rounding there just to give us an idea. So this is on the second dollar move higher, first dollar move higher. All right. Now, if we're looking at this in our favor, so now we've gone down. We're bearish in Yum for some reason, and we've gone to $85. So that first dollar move down, right? 49 cents comes into these, right? Because we moved down by $1. So if we move down by $1, a negative plus a positive, or negative plus a negative makes it a positive. So now we're looking at this being a positive delta. So now we move down by $1. These premiums are going to increase. So now we're talking about, I see your questions popping up over there. I'll get to them in just a second. So we're at $3.15 on the bid. The offer increases by 49 cents for the first dollar, and we're at $3.54, right? And then the second dollar moved down. So now we moved down by another dollar. So we're on the second dollar move, and we're trading at about $84. I'm going to try and catch you guys here in a second. So now on the second dollar, we've got a -2 or a negative plus a positive. So negative. Now we've got the 5 cents coming into that. Our next move is going to be 54 cents, right? Because the 5 cents plus the 49, we got 54 cents. So now the next dollar move higher, this same strike is now going to be worth $3.69, and this offer is going to move up to $4.08. Right? Does that make sense so far? Okay, I'm going to kind of scroll back here because I saw a bunch of them. Sometimes they have accepted various price, let you 5 in default ask. They accept 5 default price or $4.50 mid price, same way for the bid. What I usually do is, yes, usually they're going to default you. Well, when you do a spread, they're going to default you to the mid price. When you do an outright, like you go out and just buy a put or buy a call, they're going to try and default you to lifting the offer or hitting the bid, depending on which direction you're buying or selling, right? Always go, I even go just a little bit even outside of the mid price. It costs you nothing to cancel and replace. Now, I'm not saying you go in there and let it sit for, 10, 15 minutes before you change the price. What I say is go in there, put it in just a little bit better than the mid price, and then start ratcheting it closer to that mid price, cancel, replace. By the time you hit cancel, replace, and go back over to your platform, hit change, cancel, replace. That gives enough time for the algorithms to auto leg spreads and stuff like that. Because believe it or not, there's tighter markets in here than what you're actually seeing. And, I learned that on the floor because I was a spreader on the floor. So I knew that a market couldn't be represented a lien on a lien, which means if you're trying to leg a spread, you know, I'm willing to pay, you know, $3 to sell something out here. Well, if I'm selling something out here, that's a leg of a spread. Okay. So if I see there's paper out there and I'm leaning on that paper, you know, I can try and offer something to buy that outright. Okay. But that one that I'm offering out here can't really be leaned on by anything else other than maybe a local or one of these spreaders or spreading algorithms. What they'll do is they'll see that in there. They won't represent a further market because they don't know if it's going to be there until you come in and you go to that price, and then all of a sudden the algorithm goes back and hits both of them, okay, in nanoseconds. So that's why sometimes when you go in there and you'll go to like the mid price or something like that, and it'll scare you sometimes because you're like, you put it in and you're like, and you're like, oh my God, why? How did I get the mid price? Well, you didn't see it because there's all kinds of different spreads going on in there, right? Somebody else may have had a covered call strategy or something like that where it's leaning on a specific price. So it's not being represented physically where you can see it is the best way to explain that. So always kind of ratchet it down. It gives those algos a little bit of time to auto leg, and you'll get filled at the best price. It doesn't cost you anything to cancel and replace. I know that was a long-winded answer to your question, Advana. All right, got it. All right, cool. Is there a way to use Thinkorswim to see the effect of the Greeks on the premium? Yes, as a matter of fact, there is. Great question. So you can go over here on Thinkorswim and you can go to theoretical mark and price. So let me hit the reset on all of this. And what we can do is just say, all right, we're going to adjust the premium by $2 or that way $20. I'm going to increase the premium by $2. So see it's saying the result of this will be, wait, why is that $2.01? There we go. So now it's saying we're at $88. So if you go over here and look, you'll see that those premiums, it's giving you the mid price, but you can see that those premiums increased. Here, I'll go by $1 first. And we'll see that, because I can remember it was 51 cents for the first one. So you can see, was it 51 cents? Delta, 54 cents. So it was 54 cents for the first one. So you can see that theoretical mark, this mid price has increased by 54 cents, right? So 54 cents, and I think the gamma was $1, or sorry, was 5 cents. Let me just double check. So the gamma is 5 cents. So that next one should increase by 56 cents. So theoretical mark, drop this again. We've increased by $1. So this should 54, 59 cents. It should go up by 59 cents and be trading at $4 and 14 cents or something, right? $4.14. See that? Same for the bids. You're going to see these bids. Look, these dropped by 49 cents on the first one. Second one was 54 cents, right? So we're basically looking at $1.03 drop. So very close to $1.03 drop. Let me double check that. 86 cents. Let's go over here. What's the delta on this? So 49 cents. We're looking at the 86 strike. The theoretical mark increases by $1. Mid price mark is $2.95, and for the that's $2. That's why I've got that messed up. It increased by $2. So if we increase by $1, you'll see that it dropped by that 49 cents, right? Or very close to it. That makes sense. This is for a single option. How would you do the delta and the gamma impact for a long put or a short put? If you're talking about, like say for instance, you did two contracts instead of just one contract, or you're talking about how you do this when you're buying one and selling one, because they're basically going to offset, right? So same thing would be going, like for instance, in this example we're going to be doing today, if I'm buying this one, if I'm buying this 86 put, right? If it moves down by $1, my premium is going to increase by 49 cents. So if I'm buying this one for $3 and I go $10 lower, let's just call it, or let's just go down to the 75. It's $11. So if I sell that one, well, I bought this one. If it moves down by $1, this premium is going to increase by 49 cents on that first dollar. But this one is also going to increase, but by only 10 cents. So ultimately, you subtract those, right? If I'm buying a negative delta, that's negative 49, and I'm selling this one, that's a negative plus a 10. So ultimately, on a dollar move down, my delta or my strategy will increase by 39 cents for a dollar move, right? On this strategy. Does that make sense? So in a sense, I'm negative 39 deltas. That makes sense? Let's see, guys got, oh, some people are answering my questions. I scrolled up, so I missed some of these. So when the stock goes up, the gamma will add to the delta. And if the stock goes down, the gamma will reduce the delta, or the other way around. If on the call side, if the gamma goes with delta on a first dollar move higher, right? So it adds in. But if we're on a first dollar move higher, because it's a plus a negative delta, what happens is that gamma comes out of the further away, that gamma is going to subtract away from the positive plus $1, and a negative gamma or negative delta is negative, right? And gamma is positive. So plus, negative 49 plus positive 5 makes it 44. So that second dollar move, it would only decrease my premiums by 44 cents. Now, when we go down $1, right, on that second dollar move down, our negative plus a 49, or negative $2, or a negative down move plus a negative 49 makes that positive. So we're 49 positive now, right? And gamma is positive, so it's positive 54. Does that make sense? So our premium would then increase by 54. Yes, thanks for showing the platform. Okay, got it. Okay, cool. All right. So, so that is gamma. Gamma goes with delta. One thing to know is delta is negative on the puts because it's always assumed to be a positive move, right? And if we have a negative move, it's a negative, adds to a negative delta, makes that a positive delta, meaning a negative move adds into the premium. And think about it, a negative on the call side, we move down by $1 on the call side, what does that do to delta? It makes it negative. So the delta comes out of the premium on a negative move. Cool? So gamma goes with delta. It's the second dollar move. Everything's assumed to be a positive here. So if you have a negative dollar move, we have to incorporate that into the pricing, you know, a negative, and we'll get to volatility here in a minute, but theta, how do we get negative theta? Well, you go get a DeLorean. and go 88 miles an hour and hope that the flux capacitor works. That's the only way to go negative. So we don't have negative days, so theta is going to be always positive on the puts and the calls. It's theta is the thief in the night. So I don't know if you guys are getting that. Theta is the thief in the night that comes and steals our premium. So think about theta as the thief, right? Delta is data, gamma goes with delta, and theta is the thief that comes and steals our premium. Sometimes we want that thief. Sometimes we don't. And what happens is that thief gets really aggressive the closer we get to expiration. So we can see that theta is over here. On the put side, it's negative, and on the call side, it's also negative. Well, right now, every single night, he's stealing 7 cents from you. Every single night. But if we go out further in time, we can see out here 100 days or whatever, theta's only stealing 3 cents from you. Right? We can't stop theta. We can try and offset theta, right? Because if you sell a put, right? You're selling a put, well, that makes that theta a positive, right? It's a positive to your strategy. It doesn't add into it really, but it makes it a positive to the strategy. You want that to happen, right? You want the positive to happen. Just like if you sell a put, you want that negative delta, because a negative plus a negative is a positive. That's a positive to your strategy. You can think of it that way too, right? If you buy a call and it goes down by $1, a down dollar plus a positive delta is a negative to our strategy. You can think of it that way too, if that helps you kind of like process everything better. So in a sense, when we're doing this put spread, we are going to be helped out a little bit because we're doing both sides of the coin there. It's not going to help us that much, but ultimately we know theta is the thief in the night. He's aggressive, really close, like right close to expiration, but way out there down the time horizon, he's not quite as aggressive. So we're putting all this together because this gets the cogs going, you guys, right? What we need to start thinking about is, all right, how do I want delta affect me? And what does that mean? Like if I'm bearish, that means, and I'm buying a put or whatever, that means that's good for me, right? If you're bearish and you sell a put, well, that's not so good for you. But theta is the thief in the night that comes and steals our premium. So what we want to do is trying to hold off theta, right? And how do you hold off theta? Well, if you bought something, you don't want it to erode really fast, right? And we know that theta isn't as aggressive out on the time horizon. So if you're ever buying options, you probably want to go further out in time, right? You don't want to be buying an option like 1 or 2 days before expiration, because theta is like going crazy. He's really eating away at your premiums, all right? So try and think about those things when you're implementing strategies, right? These are some of the pitfalls I see people doing on TV. Like right now, they're like, hey, we're bearish. We've got this market set up and we're going out there and buying the July options. And, for one, theta is huge right there. You have to have the market move in your direction almost immediately to help to be profitable here, because 7 cent move just is going to eat away on a daily basis. You go 3 days or something like that, or 4 days, 5 days, and it hasn't really moved. You're still waiting for it to make that move. You've already lost 35 cents just from the theta. Whereas, me, I've only lost like 10 or 15 cents. Okay. So theta is the thief in the night. So every day that goes by, theta comes out of the premium. All right. Every day, theta takes away. Every day takes away. All right. We can't stop him, but we can limit what he does by picking the right strike location, or the right option expiration, I should have said. All right. So, you know, in this regard, you know, you might be thinking right now, well, he's talking about a long put here. Well, am I going to be buying the July? Am I going to be setting this strategy up in the July? You guys probably already know the answer to that. No, I'm not. All right. So when we're talking about Greeks, right? The only one that's not a Greek is Vega. You're like, hey, dude, you got a Greek sign down there. Well, this is actually, I cheated. I stole the lowercase gamma because it looks like a V. So Vega is the measure of volatility. So keep in mind, it's always positive. We're going to be thinking about it that way. That's just the way it goes. Volatility is always expected to increase, I guess. So what we're talking about here is with volatility, you know, we can look at any of the month or any of this expiration cycles in the montage here. So what we're talking about is implied volatility goes from 44.71 to 45.71. That means 1% increase. Vega adds into the premiums. Okay. So 1 percentage point increase, we're at 45.71. Our premiums will increase by 9 cents. So they would be $3.19 and then $3.44, right? And nothing else changes, right? We haven't moved up or down in price. We haven't gone a day away, all right? We've just seen volatility increase by 1 percentage point. 1 percentage point, that premium adds in. Now, what happens when we have, it goes from 44.71 to 43.71? Well, negative 1 percentage point plus a positive makes that a negative, right? So that means that volatility goes down by 1 percentage point. We lose 9 cents from our premiums, okay? So how do we take advantage of volatility? Well, when you're buying an option strategy, you need that volatility to be really low. Because we can go over and look at the charts and see, well, this is probably going to be a great example, but we can see when volatility is really low, it has a tendency to go higher. Now, this is a black swan event. I'm not going to lie. We probably won't see one of these kind of spikes in another 5-10 years maybe, okay? But having said that, volatility feels like it's here for some time right now. So we do have to kind of look at that in perspective, because we could see some crazy things happening and see that. I don't know that we're going to see that kind of volatility spike anytime soon, but we need to keep that in mind. Having said that, when volatility spikes, it comes off. Just like we can look at any of these other ones that may not have had it, but you see the volatility spikes and then they come off, all right? Volatility goes up, it comes down. So what we're trying to do is capture it like when it makes these big moves higher. So, you know, Caterpillar had that big move higher in volatility and then it came right up, right? So to me, it looks like Caterpillar's volatility is coming out. Now, volatility is coming out of the options premiums. Do we want to be buying that option premium? No, probably not. We want to be trying to capture that buying opportunity where volatility increases. You know, if volatility is going up, you know, that's helping our premiums. It could be trading completely sideways, like flatlined. If volatility is starting to increase, we can start making money. We can see our strategy increase in value if that volatility goes up and all else stays the same. Okay. So volatility affects the premium in relation to the underlying. You can see I got a strategy on there. I'm not trying to get you guys to limbing off the cliff with me and Caterpillar. I sold puts in there. I'm bullish. I sold puts in there when I had the volatility spike. So I was taking advantage of volatility coming out, even if I was directionally wrong, which I was. And that strategy isn't really being beat up too bad because the volatility is coming out, despite the fact that I was directionally incorrect. All right. So that's how we set these up so that we can increase our probabilities of success. You know, I told you guys, I don't always pick the right direction, but what I do is I set these strategies up so that I, you know, am not behind the 8 ball. I'm not getting stymied. I'm not hurting myself. I didn't buy calls in this and have the direction go against me and the volatility coming out. All of those things would have been disastrous. Yeah, I sold puts. The market started coming down. Volatility came out. So it kind of started offsetting that premium, as a matter of fact. You can see that it dropped from 56 to 46. So I had 10 percentage point decrease. 10 percentage points. That's like 90 cents, right? So, you know, that helped me. So I could have had, a $2 move, actually a $4 move at a 50 delta or something like that. You know, that would have been completely offset, right? Because that would have been the $2 difference. Or actually, no, it would have been, $2 move, because I've only gained 90 cents on the volatility decrease. So, you know, a $2 down move and 10 percentage points coming out of it, that's completely a wash. That makes sense? So we try and set it up like that. We're not talking about that in this particular webinar, but that just happened to be a cherry-picked example. Freudian slip. All right, so let's move on. Let's get on with, you're like, dude, you've been talking way too long about the Greeks. And I'm sorry, but you know, I think you guys had those questions. So I want to make sure that we've got that. So what we need to know is, where are we going? So we're taking a road trip, right? Most people plan a road trip or a vacation and spend more time doing that than they do planning their financial strategy. Yes, that is true. And you guys know you probably fall in some of that same trap. Anyway, so what we're talking about is, let's just say, for instance, I'm talking about Kroger. I think I was looking at Kroger, or let's just say we're Kroger. We're going to Kroger down here. All right. That's where I am, from Phoenix. All right. So I'm bearish, right? Kroger is down here. I expect Kroger to go down. Now, I know I'm at least going down this way somehow, right? What I need to know is a couple of things. You know, Kroger obviously is showing us we've got a bearish. Why isn't my marker? Oh, because I flipped to this. We've got a bearish assumption. So we are bearish. We're going to be moving to the negative side. So if we have a bearish assumption, we know that we're heading south at least, right? So we're heading from here and we're heading south. I don't know what road I'm going to take yet. I've got to figure out, I've got to do some planning. Do I want to go and visit these different hot spots, you know, the roadside attractions? I'm going to hit all of them. I'm not going to lie. So we know we're at least heading that way. We need to know if it is a good destination, right? Is it going to be, you know, if it's Oklahoma City, or what if it's Albuquerque? Is there anything going on in Albuquerque? I was going to pick Amarillo, and that area I love. There's all kinds of roadside attractions there. So Amarillo is definitely a stopping point down there on that road. If you guys ever get down there, try and hit Amarillo area. They've got the Big Texan and the Cadillac Ranch. So we need to know, is it a good destination? Are there a lot of things going on there? Is there a lot to do? So what we want to do is pull up the option montage and take a look at, I want to flip this. I do this option montage, so we're going to be looking at low implied volatility, right? Because think about it, if I'm buying an option strategy, I'm buying volatility in a sense. I want that volatility to go up. So right now, I want implied volatility to be very low, okay? We want to buy low, sell high. So that's one of the things we're looking at. If I want to avoid, if I'm now starting to think I'm buying something, well, I want to limit theta decay too. So we've got to think about all those things. So what we want to know is, on our route down there, if we're going to Phoenix or we're going to this XYZ stock, is it a good one to trade? I want to look at Kellogg. So Kellogg, I'm going to Kellogg. I said Kroger earlier, but I want to go to Kellogg because it's low implied volatility. So I have a bearish assumption, and for no other reason other than to make an example out of Kellogg. I don't necessarily have a bearish assumption in Kellogg. I talked about my bearish assumption, which was in Lyft last week. So that strategy is working out pretty good. If you guys are playing along in the daily market commentaries, that was the example I used for last week. I still have that on. All right. And I'm not trying to get you guys to do that. I'm just talking about how I set that up and why I had that assumption. This one I don't have a strong opinion about, but let's just say we're bearish in it. So what we need to do is go over to the option montage. It is a stock that is trading under $100. You can see I already got the thing up there. Forgot to delete it. What we want to do is look at the option montage. Any stock under $100, we look at the closest options to expiration, which these are the monthlies. The closest to 35 days to expiration or slightly inside of there is usually the spot month. That means that's where most people are trading options. Well, in this case, it's going to be the July contract. So if it's less than $100 stock, which this is, for less than $100 stock, we need the option montage down here where the bid offers in the puts and in the calls all to be less than or equal to 10 cents wide. And that actually, what I want to say is, if it's less than $100 stock and it's less than or equal to 10 cents, all right, that is in a case we're talking about a roadmap. We need to know our stoplights, right? That's a green light, all right? If it is 2 times the rule, if it's 2 times the rule, that makes it a yellow light. And if we're looking at that option montage being 3 times the rule, then that's a red light, okay? So the reason why I throw a rule out there, if it is something that is greater than $100 stock, all right, we do this thing and just move the decimal 3 ticks to the left, all right? So, for instance, if it's a $256 stock, XYZ, we'd move that decimal 3 ticks to the left, right? Well, we're looking at, 26 cents. So it needs to be less than or equal to 26 cents. That would be your green light, right? A red light would be 2 times that rule, or 50 cents, right? I'm sorry, that would be a yellow light. 2 times the rule would be, somewhere between 25 and 50 cents. That would be your yellow light, and 3 times the rule is your red light. So that would be, just say greater than 50 cents. Okay. So that's how we kind of figure out, is this underlying a good one to trade? This fits that rule for the greater part. You can see it's basically 10 cents wide across the board here. Now, the reason why that's important is because we're going to be trading further out the curve, further duration, right? Because we're buying. Well, this is where it comes into effect where I talked about the markets could be a little bit tighter, especially when you go further out the curve, right? That's where those legging algorithms aren't showing you all of the market necessarily. They're in there. They're kind of in the weeds is what we used to call them. So it's going to be more important to kind of not just go straight to the bid and the offer on the further duration strategies. You want to massage this, get in there, cancel replace on it. All right. So that's the rule for the right destination. We need to see that there are a lot of things going on in this underlying high volume and open interest. Okay. You can look over there. You can flip it over from the delta and the gamma and all that stuff. and check out volume and open interest. Just make sure looks like there's a lot of numbers in there rather than a bunch of zeros. And the beauty in this rule here is the tighter the markets are, that means free market price discovery is going on in full swing, right? It means there's a lot of eyeballs in there. It means that if, I'm at $2.60 offer in something and somebody comes in and offers $2.58 or something like that, I'm like, oh man, now I'm off the market. I go in there and step in front of him and I'm offering now 257. Well, that's free market price discovery going on. Now the guy on the bid goes, oh my gosh, they're offering, I've got my opportunity to buy it. And we start tightening up that market, okay? If you're looking at something that's one of those red light rules that I have, where it's 3 times the rule, it usually means there's very few people in there making markets. And that guy knows he's the only cat in town, It's a one-stop town or whatever. It's like if you drive through the desert out here and you see a gas station in the middle of the desert, it's an oasis. Everything in that store is super expensive. Why? Because he knows there's no competition. You've got to come to his price. And then on the way from here to Vegas, there's a perfect example of it. You just go like 15, 20 minutes further down the road and literally you're in this town and the prices for gas are like $1 cheaper. But we needed to make sure that we have a lot of things going on. We want a lot of eyeballs happening in that destination down here. So we know that this has a lot going on. We know, well, actually, we don't know yet. I haven't gone through that yet. So we know we're going south. We now realize maybe we were looking at Albuquerque, right? Albuquerque, there was nothing going on. We're like, okay, XYZ here, something related to Kellogg, and I can't think of another one other than General Mills. Maybe General Mills was really wide, but we have a bearish assumption in the breakfast cereals or something like that. We think that nobody's eating breakfast anymore. I don't know. So Albuquerque or General Mills doesn't have a whole lot of options trading going on there. It doesn't fit that rule. So now maybe, okay, now we're looking over here at Kellogg. So we want to go to that destination that has a lot of options being traded. That makes sense? So what's the environment? Here we go. I mean, what are we looking at? Is it low volatility? Low volatility means it's sunny. There's no inclement weather. We don't have to worry about breaking down. We don't have to worry about the roads being slick. We can take our time. We don't have to beeline there. We can get out, walk around, check out these roadside attractions that Wolfman loves to go and see. I want to go to the Cadillac Ranch, which is just outside Amarillo. I want to go to the Big Texan. I want to go to see the arches. I want to see the arch. I want to see what else is along this way. Can't think of anything right offhand. Oklahoma City. I don't know. So I want to kind of go like this, if it's really sunny and take all these side roads. Maybe I want to go up to the Four Corners. Don't go to the Four Corners. I've been there. It's kind of worthless. As a matter of fact, go to the Antelope Canyon. That would be a place to go for sure. That is a bucket list for me. I mean, I live just outside of there and I haven't seen it. I've been to the Four Corners. I've been to Moab. I've been to all of the national parks over there in Utah, Bryce Canyon, all that stuff. Those are all great. Four Corners. Anyway, but if it were raining, we want to stick to the highways. We want to make sure that if something goes wrong, we can get there quickly. So, ultimately that's kind of leading you towards, shorter duration when you have high volatility. But in this case, we need to know where our volatility is. I kind of showed you guys already with Kellogg. At Kellogg example, implied volatility percent is what we're looking for. Why? Because I mentioned this earlier on, right? 28 is pretty low, you know, right now. We have to look at right now. In the past, that 28 would have been pretty high, but we're in a different world right now. So 28 is pretty low for what we've been seeing, which means that we talked about how volatility affects premiums. That means if volatility, implied volatility is really low for this underlying, that means our premiums are relatively cheap for that underlying, right? Volatility is one of the major things that's going to be affecting the price swings of these premiums, right? We know theta is kind of ticking away. We know directionality will make it make or break us as well. But, you know, if we can get into this strategy where, you know, maybe I'm directionally wrong, but volatility starts going up, it can help me on buying a premium, right? So I want to get into something really low. If I go over and look at Tesla, just because I know Tesla typically has very high volatility, we can see that Tesla rarely gets down to the area we're talking about for Kellogg. You know, it's usually very high, up in the 80s or whatever. And we're looking at Kellogg and, you know, we're at 28. Tesla never gets down to 28. And our high is like 95. That's like middle of the road for Tesla. So in relationship, that's what I was talking about. We have to look where volatility, not the VIX. Yeah, VIX is going to affect all of the premiums across the board. But what we need to know is, what is 28? 28 means nothing. This 28 down here means nothing at all unless we can relate it to what's been going on in the other, in the past. Implied volatility, I don't look at historical volatility. I look at implied volatility because it's forward-looking. I like to look at forward-looking prospects like this and forward-looking even data points. But implied volatility is forward-looking, but we need to look at how that is in relationship to the past, okay? So in this case, we know we have low volatility. We know that if we have low volatility, we want to be buying premiums, right? We know that then our environment, low volatility, we have sunny. That means we can take our time. We can go and see all these crazy things over in Amarillo. I got to make sure I hit. Might move off and go up to Taos, check out Telluride, break over on one of these side roads. There's actually is a road down there. It's a really pretty drive, and head over towards Antelope Canyon, and then make my way down through Flagstaff to Phoenix. So I want to be able to take my time. Take the long road means longer duration. I need to set for myself, right? And why does volatility matter? I think I've gone over why volatility matters, because if we buy it down here cheap, volatility goes up, our premiums go up, which is what we want. You know, we don't want to buy high premiums and watch that volatility come out. That hurts us, right? We want to make sure that we are getting ourselves into a situation where volatility is high, we sell premium, volatility is low, we buy premium. Yes, I might be beating a dead horse, but I told you guys, if there's nothing else you come away from this webinar knowing, is that you have to be buying low implied volatility and selling high implied volatility, right? That will make sure you are getting yourselves into the right situation. You're going to be avoiding the pitfalls that these guys on mainstream TV are talking about, right? We also know that if we're buying premium, we want to limit theta decay, right? If we're buying volatility's low volatility is leading us to want to buy that premium. Well, we also want to limit theta decay, right? So if we're trying to limit theta decay, it means we're trying to get out the curve. All right, so implied volatility, just to go over this one more time. All right, I'm going to throw this, actually, I'm going to get rid of that. I'm going to go over to my pin here and make sure I get the pin going. Let's just go to a pin. All right, so how we figure out where this is in relation to where it's been in the past. We take where the current implied volatility is, IV, minus the low IV. All right, we take that sum and divide it by the high IV minus the low IV. All right, so we take those two sums and we divide them by each other. So right now, if we look up here at the top, we can see that this is upwards around 67. So that's our high. Our middle is right around 53. Our low is right around, we're going to call it 20. We're going to call it 22. All right, so our current is 53. So if we got 53 minus 22, right, is what I said. And then we got that high, which is right around 67, minus the low, which we said was 22, right? So now we're looking at trying to divide these two by each other. So basically, we've got 31 divided by 45, and that comes out to being about 68, 69%. I'm going to go with 69%, which means it's not 100%, it's not super high, but it is kind of high. So ultimately, what we're looking at for this rule, what we want to do is look at for this rule, anything, if it's greater than 50 IV percent, this being this number here, right? If it's greater than 50, then we want to sell premium. All right. And if it's less than IV percent of 50 for a stock, we want to be buying it. Right? Because if we look at this being, you know, kind of middle of the road, I'll flip it over here. We look at this being kind of middle of the road. We want to sell premium. We want to sell up here, and we want to buy premium down here, right? Because we can see that when it gets down here, we want to buy it on those kind of moves. We want to sell it up here when we get those kind of moves, right? You know, right here, what did we want to do? We would probably want to be looking to sell, right? We don't know where it's going to go, but we can see that it's getting a little bit lofty. We know that this was that big outlier everybody else saw, let's say. So we know that this is getting a little bit lofty up in here. So that would be kind of like that sell zone I'm looking at. You don't always know exactly where it is. What I'm talking about here is we're trying to set ourselves up for success, right? Oh, that's why it's not changing. All right, so we talked about this, right? We're leaning towards that longer duration. We want to limit theta decay. So if we're going to try and limit theta decay, we are going to take our time getting out of there, right? I'm going to go back to this. We're going to kind of trickle around. I got to make sure I hit the Cadillac Ranch. I'm going to go up and check out Taos, maybe Telluride while I'm up here. I'm going to check out the Four Corners because you can't miss it. Maybe hit Moab. There's a really great Mexican restaurant there. I can't think of what it is right now. Come down, hit Antelope Canyon, check out Flagstaff. It's pretty boring. And then head into Phoenix. Come to my house. It's more fun than Phoenix. I'm in Scottsdale. So it'll save you 45 minutes. All right. So we're going to take the long road to get there, hit a couple of key points along the way, maybe take our time. So we want longer duration. All right. So when we're buying an option, trader wants to limit that theta decay. Here's a better representation of kind of what, you know, if you're more visual on what's going to happen inside that 35 days that I told us to, you know, we want to stay away from. That's where we saw that theta number being, you know, pretty high. It was like 7 cents in my example. Well, out here, we were talking about 3 cents. So this is, you know, when we're buying, we're going to be thinking about out there on the curve. You can see that theta isn't as aggressive, but inside of here at 35 days, which is that spot month, it's a 50% drop in the premium, okay? We want to avoid that. So ultimately, let's think about this. We are buying low volatility. We have a bearish assumption. We have low volatility. It's bright, sunny skies. Duration, we need to start thinking about limiting that theta decay. All of those things are leading us towards buying a strategy which would be bearish, and that would be the long put spread. All right. We want to take our time. Maybe we're not so sure about the bearish assumption here. We want to limit some of our risk. All right. Maybe we are worried about the market moving higher. That's why you would maybe want to limit some of your risk here. So what spots do we want to visit? Well, I talked about it a little bit, but not the strike location. This is the strike location. So for the long put spread, my general rule is we're buying that in the money put. We're going to be buying it around the 84 delta, and then we're going to sell it out of the money put somewhere around that 16 delta. Now, if you want to go to the at the monies, basically you can do an at the money, which is going to be about the 50 delta. All right. And then you're out of the money. You can do this also where you're buying this one and selling the out of the money. You're going to have to go to about a 12 delta. All right. But my rule here is if you're doing this one over here, we're going to risk $1 to make $1. All right. Make $1. Should have done it like that. Make $1. All right. Risk $1 to make $1. All right. Over here on this one, we want to risk $1 to make $2. All right. So in a sense, if it was $3 wide spread, I'm going to pay $1 and ultimately, hopefully, make that extra $2, $3 wide. All right. I see a couple of your guys' questions have been sitting up there for a minute. I'm going to try and answer those here towards the end, just because I want to try and get through this for some of the people that are like, oh my God, I can't believe how long this webinar is. All right, so direction, we've got this. We're bearish. We got a bearish assumption. Destination, we know that this one is, less than or equal to that 10-cent rule, right? Or move the decimal 3 ticks to the left, right? 3 ticks to the left. The environment, we want low IV, less than 50%, which we have. Duration, we want to go out in time. We want to basically be out there. So, I'm going to say greater than 70 days to expiration, right? And the strike location, if you're going to go in the money. And now if you're in the money, you want to be pretty sure of your directional assumption. If you want to limit your risk a little bit more, go to the ones that are just at the money. If you want to limit that payment you have. No, though, the ones that are at the money, you have a lower probability of success, all right? Which means if you have a lower probability of success, that's why I need to risk $1 to make $2. If I have a lower probability of success, then I need to be paid off for it. Higher probability of success means I've got to risk a little bit more and I'm not going to get paid as much. So you're risking a little bit. The higher probability is going to switch that. All right, long put strike minus the short put strike. So the width of the spread minus the net premium. All right, so I talked about this a little bit. On the ones that are at the money, if it's $3 wide, I need to, it's $3 wide. I pay $1, then I make $2, right? That's our max profit would be then that $2 in that example. I'm going to go over a couple more here in a minute. Max loss is the premium paid. My example, pay $1. I'm only risking that $1. Break even is our long put strike minus the premium paid. So if we pay $1, we need to subtract that from the premium. We need to make up that $1. And that is at expiration, on the expiration date. In the meantime, we start making that move like relatively quickly. Our break even isn't going to matter as much for one, but you're going to see that, if you paid $1 and it moves down $1, you're going to be like, oh my God, I'm already up money tomorrow. Well, that's because this is all at expiration there anyway. All right. So on a winner, what I'm going to say here is for the winner, what I'm looking for is, basically a 33% increase. all right, in my premium. Gosh, premium. All right, 33% increase in that premium. If I paid $1, I'm looking to get out maybe $1.33, or actually 33% increase in the premium. Yeah, it'd be about $1.33. I don't usually play with the $1 ones. I go in a little bit more. A way to do it is, you just multiply by 1.33 and you can figure out where your out is there. That's on that one that is the 84 delta, right? If you're looking at that one that is at the money or out of the money or just right there, then you're kind of looking for basically a 50% increase in that premium. Okay. That's on the one that you're risking one to make 2. Now your exit on your max loss. This is where you have to do some soul searching. All right. You have to know, like, if you're getting into this on a setup, like you got the doji or whatever, and if you don't want it to break below the Fibonacci, well, that's your exit still, just like any other given trade. It breaks below a certain level, get out. With me, I'm usually looking at getting out of this at one of those Fibonacci levels usually. But if I'm doing the one that's at the money, I'm probably going to risk all that premium. All right, I'm just going to let that one ride out to be a winner. Now the 84 delta one on that spread, you know that if it goes below that 84 strike, you can't lose any more than that because that's the premium paid. But on that one, what I would look for if you really need a strategy is basically, you can look at a 50% decrease in your premium. All right, in the premium. All right, so 50% decrease in that premium that you paid, then that's where you're looking to get out. On that, that's on the 84 delta one for sure. Okay. So that's our exit strategy on that. So let's just take a couple looks real quick. I know I'm keeping you guys here longer. For some reason, this webinar seems to take a little bit longer. I talk a lot more than in the past with my webinars. So we are bearish. We find the rule. Yes, it fits the rule. All right. The rule of tight bid ask. We can probably go over here and see that they have a lot of volume and open interest going on. You can see there's pretty good volume and open interest. They have tight markets, so I'm going to go with it. I'm going to go out at about the 85 days to expiration, right? Because that's where I was talking about getting out on that curve. We're limiting Theta. You can see it's only 2 cents a night. And we're going to relatively be able to offset it. So if I was going to go with the ones that are like just at the money here, I'm going to buy this. Now, remember, I said we're going to risk 1 to make 2. Well, in this sense, if I'm looking at a $3 debit, I've got to be kind of thinking $10, right? At least $10, because that I'm paying $3 and I need to make that, other $7 or whatever to make it at least making 2. Does that make sense? $3 to make $7. Risk 1 to make 2. That's a little bit better than that. So $3, I got to be thinking $10 wide. So I'm going to go to the 55 strike here. Sell that one. $2.68. So that's easily risking 1 to make 2. So I could tighten it up a little bit, but I would probably go with something like that for that strategy. That fits the rules. We checked all these off as we went along. All right, so that one has a little less probability of success, right? But, I have a higher reward potential. So you're going to have to weigh those. The other option would be to go with the ones that are just in the money. And I'm going to be looking at probably the 75. I said the 84 delta or somewhere around there. It's a pick 'em. Let's start out with the 75s just because I don't want to go with the half strikes necessarily. And then I'm going to go, I've got $10 wide, right? Or $10. So I've got to be thinking $20, right? Because I've got to risk 1 to make 2 to fit these rules. So if I'm risking 1, which means I'm paying $10, I've got to at least be $20 wide. So go down to the 55 strike. Another way to look at it is if I'm paying this $10, I'm at the 75 strike. Another thing I want to think about is I want to pay off all the extrinsic value. Well, if you go over to the corresponding put, you can see that the corresponding call, corresponding option, I should say, in the money puts at intrinsic value and extrinsic value. Go over there and look at the corresponding option. You can see a ballpark as to where the premium is that I need to collect in order to pay off that extrinsic value. So I saw 65, so that's where I went with that as well, right? So that's easily risking one to make one. So that's how we set those strategies up. Go as close to that 84 delta for the in the monies, and if you're doing the out the monies, you need to make one or risk one to make two. This is risk one to make one in this regard, okay? So for instance, on the exit though, on a loss for here, on this particular one that I'm looking at, it starts trading around $4.50, then that's where I'm out, okay? The other thing I could be looking at, if this market started rallying and broke above this Fibonacci, then I would be out, okay? You do have to be concerned with earnings. Don't ride this, especially if it's a winner, don't ride this through the earnings, okay? Get out, because that volatility crush, you're going to have made money on the volatility expanding. Get out before that volatility crush happens, because you could be directionally right and lose all that money, all right? We don't want that volatility coming out dramatically, because we could be directionally right and lose some of our premium. Get out early, all right? If it's already at a full loser though, you know, then what do you got to lose, right? In that case, I'd write it out through that earnings. But if it was a winner, you're definitely covering this before a earnings event. All right. Any other questions then? So with the long put 86 and the short put, the $75 move would equally affect the long put and the short put, right? If we're talking about long put 86.75, and that was a real old example you were looking at, these aren't going to be affected the same. This one, you know, we have to go a little bit wider, risking one to make two, because these deltas are going to, you know, for every dollar move down, you can see my deltas are kind of offset. In this one, we're looking at the 65.55 in this example, right? Well, you can see that I'm only going to increase in value for every dollar move down. I'm only going to increase in value by about 35 or 34 cents, right? So I need to make up that ground. Whereas on this one, where it's the 85.55, you know, for every dollar move down, I'm gaining 76 cents, right? So, you know, I do still need to have the right directional move, but my value of my spread is going to increase much faster. So sometimes you're able to get out of this spread, this deeper in the money spread, a little bit quicker. But we're also only looking at increasing in value by 33%. You know, and 33% on $10, that's a pretty good premium increase. You know, that's a pretty good win, right? Which is another reason why on this one, you know, I need to make sure that I'm thinking, okay, I need about a 50, I need about a 50%. I'm looking at about a 50% increase here. So $1.30. So I'd be getting out at $3 or $4 on this one. Okay. What about the gamma impacting on the two legs? Well, gamma on this one, you can see, is going to help me, because the gamma on the short leg, you know, gamma is on a directional move. It's going to hurt me, right? Delta is going to hurt me. Gamma is going to hurt me. Gamma is only going to hurt me at 2 cents. So ultimately, you know, it's going to hurt me by 2 cents, but it's going to help me by 5 cents here. So ultimately, every dollar move down, you know, gamma is going to be helping me, albeit slightly. It will. Now, on the ones that we were looking at on the 75s, here, you can see the 75, 55, the gammas are offset. They're going to be relatively equal. You know, the further this strategy comes closer on this one, the gamma is going to hurt me a little bit more, but, you know, the delta is going to get jacked up too quickly. Okay. Cool. All right. Sweet. All right. Thank you guys for sticking around much longer than normal. Here is your offer that we're going to be giving out to you guys. It's the Options Lab. Full access. If you guys sign up right now, the link is over in the chat window. We've been going back and forth in the questions box over there in that chat window. I just threw it out there. Is this link, if you're watching on tape delay, you're going to have to hit this up. Take advantage of this quickly because it is, you know, our access for being the first 100 members is getting much closer to being full. Instant access to the entire Wolfman Options courses. I'm not going to pull up the website right now. I usually do, but there's so much in there. There's over 100 hours, which means there's over 100 webinars in there. So go check those out. You know, not every webinar on even the long put is the same, just like this is completely different. Some of those other ones are even different yet because you guys drive the content. You know, I see what you guys are asking. I want to make sure you're clear of concept. Somebody else might have asked a different question over there that that you'll see brought up, and you know that'll get your cogs turning again. I'm going to dig into that as well. So first 100 members will be charter members. That gives you the instant access. You'll also get free upgrades to the Options Lab with the membership status there. Future content, future promotions. Also, you get access to me, you guys. If you're signed up for this, you guys get question and answers. You guys can email me whenever you want. I know a lot of people recently have been taking advantage of that, especially in this type of environment we're in. It doesn't even have to necessarily be about the options. You could be talking about, you know, trade patterns and stuff like that, Fibonacci's, market profile. I'll talk to you guys about anything you want. I want to make sure you guys are clear on all of that so you get access to me and a lot more. So, and if I can't answer your question in an email, I've gotten on Skypes. I've gotten on the phone with people. Especially recently, it's sometimes easier to do it on Skype where I can go over there and, you know, screen share and stuff. So take advantage of that. Like I said, it's over there in the window for the chat. Make sure you take advantage of that. Again, if you're watching on tape delay, this is the link. One last thing, I just want to thank you guys all for participating. Later webinars, I'll drill down on different option components when and where I find those appropriate. Here is the link again. You can have any questions, reach out to us at 310-598-6677 or trading@protraderstrategies.com. We'll take care of you there. Finally, yes, the boring part of the webinar. I see a couple questions. I'll get to those here in a second. Read over the disclaimer. I'm not trying to get you guys living off the cliff. I do not believe in giving out investment advice. I'm not trying to say go out there and buy this put spread in any specific underlying that we talked about because of a bearish assumption that I came up with. No, what I'm trying to do is go through all of this so you guys can think for yourselves, all right? Come up with your own assumptions. It could be just as good as mine or anybody on TVs, all right? Those talking heads don't know any more than you or I. So make sure you take advantage of that. Going over this anyway. Go back to the link there. But yeah, the link's over there inside. You can scroll through. You can see there is tons of content. Also, you'll get all of the daily market commentaries and all that stuff too. So that's where I talk about all my trades. All right. Does this give us access to repairing trades, etc. with the lab? Yeah. Rashad, if you have a question on repairing a trade or how I would do something like that, absolutely. Reach out to us if you're taking advantage of this. You have full access to me. All right. I will make sure you are taken care of. We can go through your example that you have specifically. I can tell you what I would do. I can't tell you what I think you should do. All right. I would say, according to my rules, this is what I would do. Now you have to say, all right, this is my risk parameter. This is what I'm feeling, you know, and we'll go through all that stuff. Absolutely. Great question. Yeah. And if you wanted to talk about charts, like what do you think about XYZ? I can tell you what I think about it. I can't tell you what I think you should do. You know, I have one guy that we were talking online, and you know, he thinks gold is or on Skype, and he thinks gold's going to go through the roof and go to the moon. Well, I don't have that assumption. I thought it was going to break out, but I don't think it's necessarily going to break through 1800 anytime soon. That's just my assumption. I think it's good. If it gets up to 1800, it's going to, you know, lose a little steam. I have a long strat, or took it off today. As a matter of fact, if you watch some daily market commentary, I took it off on today. But I thought it was going to break through to the upside. So I put on a long call spread, and I was going to I actually almost made that my example for this. And then I was like, dude, you're doing the put spread. You can't be doing an example of the long call spread, cherry pick. But, you know, if you watch the daily market commentaries, you saw that when I put it on and when I took it off, which was today, for that 33% increase in the premiums. All right. That's all I got then, guys. Thank you guys so much for joining and sticking around much later than normal, 30 minutes. You guys are champions. If you can't take that, take it easy. Thanks, Prashad. Appreciate it. Love the questions, man. Keep it alive. John David, I just saw your question there. Won't the Vega being 9 for the long put and the 4 for the short put reduce the total Vega by 5? Yes, the Vega would help you if volatility increased. The Vega, the overall effect on the strategy would increase by that 5 cents. Correct.